Okay, let's unpack this. What if I told you that even if you're like a brilliant stock picker or a really savvy bond investor, you could still be leaving massive amounts of money on the table? Not because you chose the wrong investments necessarily, but because you put them in the wrong place. We're talking potentially tens, maybe even hundreds of thousands of dollars over your investing lifetime. Just gone, lost to taxes.
It's a reality. A lot of investors face it without even realizing it. They spend countless hours just agonizing over their investment mix. What percentage goes into stocks versus bonds, which sectors to favor.
Right, the usual stuff.
That's the critical concept of asset allocation, AI. And look, it's undeniably important. Can't argue with that. But it's really only half the story.
Only half.
Yeah. The other half, the part that dictates how much of those hard-won gains you actually get to keep after taxes, that's something called asset location, AL.
Exactly. It's such a crucial distinction, and it can have just a profound impact on your net worth over time. Think of it like building a state-of-the-art race car engine. That's your asset allocation, your mix.
Okay.
But then putting it into a car body that isn't really designed to handle its power efficiently, specifically from a tax point of view, doesn't work well.
That's a good analogy. You lose efficiency. You lose performance after tax performance in this case.
So today we're going to do a deep dive into why where you hold your investments is just as vital, really, as what you hold, and how understanding asset location can be a genuine game changer for U.S. tax efficiency.
Yeah, and our exploration today, it draws from quite a stack of sources. We're looking at practical guides from places like Vanguard, Investopedia, insights from financial experts, discussions you find in savvy investor communities like Bogleheads.
Oh yeah, those forums are great.
And analysis from firms like Beck Capital Management too. And they all pretty much underscore the power of this strategy. It's often overlooked, but it's powerful.
Okay, so our mission today is clear. We need to distinguish asset allocation from asset location. Explain the mechanics, how AL actually leverages the U.S. tax system. Walk through the practical strategies, how to put assets in the optimal places. Then we have to talk about the real-world complexities, because it's not always simple.
Definitely not.
And ultimately, show you, the listener, how this knowledge can potentially put significantly more money back in your pocket.
Right. So to start, let's maybe set the stage with the concept most investors are familiar with, asset allocation, AA.
Right. Asset allocation, AA really is the bedrock, isn't it? The foundation of your whole investment strategy. At its core, it's about deciding that high-level mix of different asset classes you're going to hold. Are you heavy on stocks? Do you want a big chunk in bonds? Maybe some cash sitting there? Or even alternatives like real estate, commodities. It's that top-down decision, the overall makeup.
And the main goal, the primary purpose of AA, is managing that relationship between potential return and risk. Your ideal mix is, it's deeply personal. It's driven by your specific financial goals.
Like retirement saving versus a down payment.
Exactly. Are you saving for retirement decades away or for that house next year? Your time horizon matters hugely how long until you need the money. And critically, your tolerance for volatility. How much sleep do you lose seeing your investments bounce around?
Yeah, the sleep test is real. And it's often quoted, right, that diversification across asset classes that aren't perfectly correlated is the only free lunch in the investment game.
You hear that a lot.
The logic is, by spreading investments across different types of assets that react differently to market conditions, you can potentially reduce the overall swings, the risk of your portfolio without necessarily giving up expected long-term returns. Our sources definitely echo this fundamental idea.
Absolutely. And the sources we looked at, they also touch on the fact that getting this desired mix isn't like a one-size-fits-all thing. There are different ways to approach it, different strategies.
Different methodologies.
Yeah. You've got strategic asset allocation that's setting long-term targets, sticking to them, rebalancing regularly. Then there's tactical asset allocation, where you make shorter-term adjustments based on what you think the market might do.
Trying to time things a bit.
A little, yeah. Then dynamic asset allocation, which adjusts the mix based on broader economic shifts. The core satellite approach, using a stable passive core, maybe index funds, with actively managed satellite investments around it.
Okay.
And of course, the simpler stuff like age-based or life cycle funds, think target date funds that automatically get more conservative as you get older. It just shows that AA itself is a pretty nuanced strategic decision about your overall risk exposure.
Now, academic research has looked at asset allocation extensively, and it strongly supports its role in explaining portfolio volatility. That seems pretty settled. Studies consistently show that your choice of asset mix accounts for a huge percentage of how much your portfolio's value jumps around over time.
And that is important. Controlling volatility is key for staying invested. However, while AA is huge for volatility, there's this fascinating ongoing debate, some sources touch on this, about exactly how much AA explains the actual level of long-term performance.
Performance versus volatility.
Right. Compared to other things like picking the right stocks or bonds or market timing. Earlier interpretations may be a bit oversimplified. Sometimes suggested AA explained over 90% of performance.
I remember hearing that number.
Yeah. But more recent analysis clarifies it might explain a large chunk of the variance in performance between different portfolios, rather than explaining the absolute return of one single portfolio over time. It's a subtle difference, but kind of important academically.
Got it. So it explains why my portfolio bounces around differently than yours, more than it explains my absolute final number.
Roughly, yes. And beyond the academic side, the sources point out that even if you have a theoretically perfect asset allocation strategy on paper, there are real-world hurdles. Investor behavior is probably the biggest one.
Oh, definitely. Having a plan doesn't stop you from freaking out and selling low in a crash.
Or getting greedy in a bubble.
Exactly.
Yeah, the human element. It's maybe the biggest variable that the standard financial models really struggle with. And also, relying too heavily on historical data, how stocks and bonds did in the past, how they moved together.
That correlation can change.
It absolutely can.
Yeah.
It's always a potential weak link because the future never perfectly repeats the past. Market conditions, correlations, returns, they shift.
Okay, so let's say you've done the hard work. You've thought about your goals, your timeline, your risk comfort level. You've decided on your ideal asset allocation. Maybe it's a classic 60% stocks, 40% bonds, maybe a bit of international, some cash. You know what you want to own.
You've got the blueprint.
Right, but here's where the money-saving magic, potentially, of asset location comes in. Because knowing what to own is one thing. Knowing where to own it, that's another level. And it can make a huge difference to your after-tax wealth, particularly with the way the U.S. tax system works.
And this brings us nicely to that second side of the investment coin, the often underappreciated strategy, asset location, or AL.
So unlike asset allocation, which is about the composition, the what, asset location is purely about the placement, the where. It's the strategic decision of where within your various investment accounts, your 401k, your IRA, your brokerage, you hold each specific type of asset.
Are your bonds in the 401k? Are your growth stocks in the Roth? Or are they all jumbled together in a taxable account? That's AL.
Exactly. And to really grasp asset location, you absolutely have to understand the different kinds of investment accounts available to U.S. investors and, crucially, how they're taxed differently. Our sources lay this out pretty clearly.
Yeah, let's break those down. First up, you've got your basic taxable accounts.
Your regular brokerage account.
Right, like one you'd open with Fidelity, Schwab, Vanguard, whoever. The key thing here is that investment income, like interest from bonds, dividends from stocks, and also realized capital gains.
Profits when you sell.
Right. Profits when you sell an investment for more than you paid those are generally taxable in the year you receive or realize them. You get that 1099 form at tax time. You report the income, you pay the tax. Pretty straightforward, if potentially painful.
Then you have the tax-advantaged accounts. Let's start with tax-deferred accounts.
Okay. The most common examples here are traditional IRAs and employer plans like 401k, 403bs, things like that. With these, the big advantage often comes up front.
The tax deduction now.
Exactly. Contributions to a traditional 401k or deductible IRA contributions reduce your taxable income today. Then, the investments inside grow, and this is key. Any interest, dividends, or capital gains generated within the account are shielded from taxes year after year. They grow tax deferred.
But you do pay taxes eventually.
You do. Taxes are only paid later, typically in retirement, when you start taking money out. And at that point, the withdrawals are generally taxed as ordinary income.
So you kick the tax can down the road, maybe hoping you'll be in a lower tax bracket later. But the tax man eventually gets paid.
That's the deal with traditional tax deferred. And finally, arguably the most powerful tax shelter, especially long-term, are the tax-exempt accounts.
Or Roths.
The Roths, Roth IRAs, Roth 401k. With Roth accounts, the setup is different. You contribute money. You've already paid taxes on what we call after-tax dollars. So no upfront tax deduction when you put money in.
Okay.
But the huge benefit, the payoff, comes later. Your investments grow entirely tax-free, and then qualified withdrawals in retirement are completely 100% tax-free.
That combination, tax-free growth and tax-free withdrawal, incredibly powerful, isn't it? Especially over like 20, 30, 40 years.
It really is. Think about it. Every dollar of interest, every dividend, every capital gain compounds completely untouched by taxes. And when you finally take it out in retirement, assuming you meet the rules, Uncle Sam gets zero. Nada.
Amazing. So asset allocation uses these differences in account types. And you said it also leverages something else.
Yes, it also leverages the fact that different types of investment income are taxed differently under U.S. law. This is the second crucial piece.
Right. The different tax rates. Our sources detail this, like interest income, what you typically get from holding most bonds, like corporate bonds or government bonds.
That's usually taxed at your ordinary income tax rate, the same rate that applies to your salary or wages. And for many people, especially higher earners, that can be the highest tax rate they face, currently up to 37% federally. Ouch.
Yeah, that hurts. But then you have other types of income that get better treatment.
Exactly. Qualified dividends, those are dividends from certain U.S. stocks and some foreign ones that you hold for a specific period, and long-term capital gains.
Profits from selling assets you held for more than a year.
Correct. Held more than 1 year. These get preferential tax treatment. They're taxed at potentially much lower rates, 0%, 15%, or 20%, depending on your overall taxable income.
Big difference from 37%.
Huge. Now, higher earners might also face that 3.8% net investment income tax surcharge on top. But even so, these rates are often significantly lower than ordinary income rates.
But there's a catch with capital gains, right? Short-term versus long-term.
Crucial distinction, yes. Short-term capital gains. If you sell an asset you've held for 1 year or less at a profit, that gain does not get the lower long-term rates. It gets taxed as ordinary income, just like your bond interest.
Ah, so that's important if you're trading frequently or have funds that do.
Very important, especially for things like actively managed mutual funds that might have high turnover. They could be kicking off short-term gains tax at your highest rate.
Okay, so putting these two pieces together now, the different account tax rules and the different tax rates on investment income. The goal of asset location starts to become really clear.
Right. It's about strategically matching the type of asset, considering the kind of income or growth it's likely to generate, and how that's taxed with the type of account that offers the most favorable tax outcome for that specific asset.
To minimize the tax drag each year.
And minimize the total taxes paid over your entire investing lifetime, which ultimately maximizes your after-tax returns, the money you actually get to spend.
Okay, let's really drill down now on this critical distinction. You've got your asset allocation, the what? Your 60-40 stock bond split, your mix of large cap, small cap, international, whatever. Then you have asset location, the where. Why does this where matter so much for U.S. tax efficiency?
It matters, fundamentally, because the tax rules are different. Different accounts offer different shelters or benefits, and different assets throw off income that's taxed differently. Asset allocation is your blueprint for risk and return, your strategy. Asset location is the tax optimization layer you apply on top of that blueprint.
So you set the AA first?
Generally, yes. You figure out your ideal mix first.
Yeah.
Then you look at all the accounts you have, your 401k, your IRA, your Roth, your taxable brokerage, and you strategically decide which assets from your overall target mix go into which specific account to be the least amount of tax legally possible.
Yeah.
They're distinct, but AL is essential for implementing your AA efficiently.
And the reason it's so critical for U.S. tax efficiency, as we just covered, is that huge disparity in tax rates.
Mm-hmm.
Parking an asset that generates highly taxed ordinary income, like, say, a corporate bond fund paying interest, putting that directly in your taxable brokerage account means you're paying those high ordinary income rates every single year on the interest. That's a significant ongoing tax drag that just directly eats away at your total return.
Exactly. Which leads us to that simple sort of foundational rule of thumb you often hear highlighted in the sources, though. But, it's a starting point. It needs nuance.
Okay, what's a rule of thumb?
Bonds in traditional tax deferred, stocks in taxable.
Bonds in traditional, stocks in taxable. And the logic there is based purely on those tax rates we discussed.
Pretty much. Bonds generally generate that high taxed interest income. So you want to shelter that income from being taxed annually. A traditional IRA or 401k does exactly that. It defers the taxes until you take the money out, hopefully later when your rate might be lower.
Okay.
Stocks, on the other hand, generate income, dividends, and gains that can be taxed at those lower preferential rates. Qualified dividends, long-term capital gains. Since taxable accounts let you actually get those lower rates, stocks can be more tax efficient sitting there compared to high-interest bonds. You're not wasting the tax shelter on income that already gets a lower rate.
That makes intuitive sense. But then what about the Roth? Where does that fit in?
Ah, yes. The rise of Roth accounts, as noted by Vanguard and others, adds another layer, another really valuable bucket to think about. The Roth's tax-free growth and tax-free withdrawal makes it the ultimate tax shelter, right?
The best deal, tax-wise.
Arguably, yes. Which means it's often the most valuable place for assets you expect to generate really significant returns over the long haul. Or maybe assets that have higher tax characteristics you want to eliminate completely, because those gains will never face taxes again, ever.
Okay, so this all sounds important theoretically, but what's the actual tangible impact? Are we talking just, pocket change saved here and there, or something bigger?
Well, this is where the research gets pretty compelling. Vanguard, for instance, they've published analysis looking at the potential impact. And their research suggests that consistently applying sound asset location principles can potentially boost your after-tax returns by a meaningful amount. They cite a range of between 0.05% and 0.30% per year.
Okay, 0.05% to 0.30% per year. I mean, less than 0.5%. That might still sound kind of modest to some listeners.
It might sound small initially, yeah. But you have to remember compounding. Over long periods, decades of investing, even small percentage improvements add up significantly, don't they?
Oh, absolutely. Compounding is where the magic happens. That extra bit saved from taxes gets reinvested and starts earning returns itself.
It absolutely does. And Vanguard illustrates this with a concrete hypothetical simulation. They modeled a specific portfolio, started with $1 million, had a 50-50 stock bond mix over a 30-year period, spread across different account types, traditional, Roth, and taxable.
Okay, a realistic scenario for some.
And in this simulation, applying what they deemed optimal asset location principles resulted in approximately $74,000 less in taxes over the next 30 years, compared to a strategy where assets were just placed without regard to tax efficiency.
Wow, okay, $74,000 less in taxes over 30 years in that specific simulation. That's not marginal. That's real money. That could be, I don't know, a nice car, a significant chunk of a down payment, maybe years of retirement expenses for some people, or just more left for heirs. It really drives home the potential value here.
It's a very powerful illustration. But, and this is really essential, we need to understand the context, as Vanguard themselves are careful to clarify. That $74,000 figure, it's based on a specific model with a whole set of specific assumptions.
Right. Models always have assumptions. What were some key ones?
Well, key assumptions in their analysis included things like maintaining that consistent 50-50 stock bond split the entire time, which means annual rebalancing to stay on target. They assumed a particular withdrawal order in retirement, starting with taxable accounts, then moving to tax-deferred, and finally tapping the tax-free Roth accounts.
Okay, that sequence matters.
Big time. They also had to assume specific tax rates for ordinary income, capital gains, dividends, and even for bequests. And they relied on their own proprietary capital markets model to project the returns and income streams over that 30-year period.
So basically, while that exact $74,000 number is hypothetical, tied to those specific inputs, and obviously your actual results are going to vary based on your unique portfolio, your tax situation, how the market actually performs, how you manage your accounts.
It absolutely hammers home the point that the tax drag from not optimizing asset location is real. Yeah. And the potential savings from doing it right are tangible and can be substantial over an investing lifetime. It really elevates tax planning from just, filling out forms to being a core strategic investment tool.
Okay, so armed with this understanding, the different accounts, the tax rates, the potential impact, let's get practical. How do you actually put assets in their right place? What are the specific strategies the sources recommend?
Right. Let's get into the weeds a bit. Based on those tax characteristics we've laid out, the sources provide pretty clear guidance on placing different types of assets to try and maximize that tax efficiency.
Okay, where do we start? How about assets that generate that high tax income? You mentioned taxable bonds, corporate bonds, government bonds paying interest.
Right.
What about REITs?
Yeah, those are the prime examples. Taxable bonds and often real estate investment trusts, or REITs, because a significant portion of their distributions tend to be taxed as ordinary income. These are prime candidates for sheltering.
Sheltering where?
They're generally best placed in your tax-deferred accounts first, like your traditional IRA or 401k. Or even better, if you have the space and the option, in your tax-exempt accounts, your Roth IRA or Roth 401k.
Why the Roth even better?
Because in a Roth, that ordinary income effectively becomes tax-free forever, not just tax-deferred. But either way, putting them in tax-advantaged accounts shields that high-taxed ordinary income from being taxed every single year. In a traditional account, taxes are deferred, maybe until you're in a lower bracket. In a Roth, gone forever. It protects your returns from that nasty annual tax drag.
Okay, shield the high tax stuff. Makes sense. Now, what about the other side? Assets considered more tax-efficient growth assets. You mentioned things like individual stocks, broad market index funds, ETFs, especially those holding U.S. stocks and paying qualified dividends.
Right. For these, the common recommendation is often to place them in your taxable accounts.
In the taxable account. Why?
Will they be taxed? They will, but the rate is often lower. The primary income from these assets, qualified dividends, and long-term capital gains, gets taxed at those lower preferential rates we talked about, 0%, 15%, 20%.
Yeah.
While you do pay tax annually on the dividends, and when you eventually sell at a gain, the rate itself is lower than the ordinary income rate you'd likely shield bonds from.
So you're saying don't waste the valuable tax-sheltered space, like in your IRA or 401k, on income that already gets a lower tax rate anyway. Save that space for the really high tax stuff.
That's the core logic, yes. Put the tax-efficient assets where they can benefit from the lower rates available in taxable accounts and reserve the limited tax advantage space for the assets that generate income taxed at higher ordinary rates.
And you mentioned earlier there are other advantages to holding stocks or growth assets in taxable accounts, right? Things you can't do in an IRA or 401k.
Exactly. Two big ones, the sources point out. First is tax loss harvesting. If you hold an investment in your taxable account and it loses value, you can sell it to harvest or realize that capital loss.
And that loss does what?
That loss can be used to offset capital gains you might have realized elsewhere in your portfolio from selling winners. And if your losses exceed your gains, you can use up to $3,000 of the excess loss to offset your regular ordinary income each year. Any remaining loss carries forward to future years. It's a powerful way to turn lemons into lemonade tax-wise. Only works in taxable accounts.
Got it. And the second big one, something about heirs.
Yes, the stepped-up cost basis rule. This is huge for estate planning. If you hold appreciated assets, like stocks that have gone way up in a taxable account, and you pass away, your heirs inherit those assets with a new cost basis. Their basis gets stepped up to the fair market value of the asset on the date of your death. Meaning if they turn around and sell those inherited assets soon after, they'll owe little or no capital gains tax because their starting point for calculating the gain is the value when they inherited it, not your original low purchase price. This can wipe out potentially huge tax bills for heirs.
Wow. And that doesn't happen with retirement accounts.
Generally not in the same way. Assets inherited from tax-deferred accounts, like a traditional IRA, are typically still taxed as ordinary income to the heir when they withdraw the money. The step-up in basis is a specific benefit of taxable accounts.
Okay, that's a major planning point. And within this category of tax-efficient growth assets for taxable accounts, you mentioned passive index funds, or ETFs, are often better than actively managed funds. Why again?
Yeah, it boils down to turnover, mostly. Actively managed funds are constantly buying and selling securities, trying to beat the market. All that trading inside the fund can generate capital gains, sometimes short-term gains, taxed at high rates.
And the fund passes those gains to you.
Exactly. The fund is required to distribute those realized gains to its shareholders, usually near year-end. And you, the investor, have to pay taxes on those distributions, even if you never sold a single share of the fund yourself and just reinvested the distribution. It's a forced tax event.
Ugh, phantom income.
Pretty much. Passive index funds, or ETFs on the other hand, just aim to track an index. They buy and sell much less frequently. As a result, they tend to generate far fewer capital gain distributions, making them inherently more tax efficient to hold in a taxable account. Less unexpected tax bills.
Okay, good tip. Now, what about assets that are already tax advantaged themselves, like municipal bonds, muni bonds?
Ah, yes, the big exception to the bonds go in tax-deferred rule of thumb. Municipal bonds, as you know, are issued by state and local governments. The interest they pay is typically exempt from federal income tax.
And sometimes state and local, too, if you buy bonds from your own state.
Correct. So the income is already largely tax-free. Where do you put them?
It seems like you wouldn't put them in an IRA or 401k then.
That's exactly right. The recommendation from the sources is clear. Place municipal bonds in your taxable accounts. The logic is simple. Putting an asset whose main benefit is tax-free income into an account that already provides tax benefits, like an IRA or 401k, is redundant. You gain no additional tax advantage beyond what the muni bond itself offers. You're essentially wasting precious tax-sheltered space that could be better used by assets generating highly taxed income or those with high growth potential that would be taxed heavily elsewhere.
Don't double dip on tax benefits that don't stack.
Got it. Okay, let's consider assets with potentially high growth or high turnover. We talked about active funds maybe generating short-term gains.
Yeah.
Where do those best fit if you choose to own them?
Right. While tax-efficient long-term growth, like from index funds, is often fine for taxable accounts, if you specifically own an asset you anticipate will generate significant short-term capital gains taxed at ordinary income rates, or if you're holding that actively managed fund known for high turnover.
Then placing it in a tax-exempt Roth or a tax-deferred account can be really beneficial. This shields those potentially frequent high-taxed ordinary income events from hitting you annually in your taxable account. Shelter the short-term stuff if you can.
Okay. And what about just plain risky or volatile investments? Maybe individual stocks you think might moon but could also crash?
These can actually have a strategic place in taxable accounts, specifically because of that tax loss harvesting opportunity we discussed earlier.
Ah, the harvesting again.
Yeah. If you take a flyer on something volatile in your taxable account and, it doesn't work out, it tanks, you can sell it and realize that loss. That loss can then offset taxable gains from other investments that did work out, reducing your overall tax bill. You turn a bad investment outcome into a small tax silver lining. You can't harvest losses inside an IRA or 401k.
Makes sense. Use the taxable account structure to your advantage, even with losers. And finally, just to reiterate, assets you specifically plan to leave to heirs.
As we covered with this step up in basis, if leaving assets to heirs is a major goal, holding highly appreciated assets you intend them to inherit in taxable accounts can be extremely beneficial for them tax-wise. That stepped-up cost basis upon your death can wipe out their capital gains tax liability, which is a much better outcome than inheriting funds from a traditional tax-deferred account that they'll have to pay ordinary income tax on.
Okay, wow. That's a lot of specific strategies. Let's try to make it concrete. Let's use a hypothetical investor, Sarah. She's aiming for a balanced asset allocation, 60% stocks, 40% bonds, and she has 3 account types: a traditional 401k through her job, a Roth IRA she contributes to, and a regular taxable brokerage account. How would Sarah apply these asset allocation principles across her accounts?
Okay, great scenario. Following the guidance from the sources, Sarah would first look at her total investment dollars across all 3 accounts combined. She knows her target is 60% stocks, 40% bonds overall. Now, where does each piece go?
Let's start with the bonds. 40% bonds. Where do they go first?
Her 40% bond allocation, which generates that highly taxed interest income, should be prioritized for her tax-advantaged accounts. The first place she should try to put them is her tax-deferred traditional 401k. She'd fill that up with bonds towards her 40% overall bond target, up to either the account limit or her contribution limit.
Okay, 401k first for bonds. What if her 401k isn't big enough to hold all 40% worth of bonds, or she hits the contribution limit?
Good question. If her 401k is filled with bonds, but she still needs more bond exposure to reach her 40% overall target, the next best place for the remaining bonds would be her tax-exempt Roth IRA.
Roth second for bonds. Why Roth before taxable?
Because the Roth still offers tax benefits, tax-free growth and withdrawals, even if the income type interest isn't ideal for it. It's still better than the taxable account where that interest will be taxed annually. So traditional 401k first, then Roth IRA for bonds. Only if both her 401k and Roth IRA are completely full of bonds, and she still needs more bond exposure, would she resort to placing taxable bonds in her taxable account. That's the location of last resort for bonds.
Okay, so shield the high tax bonds first, prioritizing traditional, then Roth, then taxable only if absolutely necessary. Got it. Now, what about her 60% stock allocation?
Right. Her 60% stock allocation, which is generally more tax efficient, generating lower tax qualified dividends and long-term gains, would primarily be directed to her taxable brokerage account.
Stocks mainly in taxable.
Yes. That's where stocks can benefit from those lower long-term capital gains and qualified dividend rates when sold or received. Plus, she gets the potential for tax loss harvesting in that account and the step up in basis for heirs if that's relevant.
Okay, but what if her taxable account isn't big enough to hold her entire 60% stock allocation target? Or she wants to put more into retirement accounts?
If her taxable account gets filled up with stocks according to her plan, but she still needs more stock exposure to reach her overall 60% target, the remaining portion of her stock allocation would then ideally go into her tax-exempt Roth IRA.
Ah, so stocks overflow into the Roth after the taxable account.
Often, yes. The Roth is an excellent place for growth assets like stocks, because any future appreciation, potentially large gains over decades, will be entirely tax-free upon withdrawal. So it makes sense to put stocks there after you've utilized the taxable account's benefits, lower rates, harvesting, step up, and filled it to your target, or if you specifically want maximum tax-free growth potential shielded in the Roth.
That makes sense. It's like a hierarchy. You fill the tax advantage buckets first with the stuff that most needs sheltering, bonds, prioritized in traditional, then Roth. Then you fill the taxable account with the more tax-efficient stuff, stocks. And any remaining stocks overflow into the Roth to capture that ultimate tax-free growth.
Exactly. It's about prioritizing the use of your limited tax advantage space. Use it for the assets that benefit most from shielding high-tax income generators, or offer the greatest potential for completely tax-free growth, often high-growth stocks, ideally in a Roth.
Let's revisit that Investopedia example quickly because it really showed the stark difference in taxes on the same dollar amount. Remind us of that.
Right. It's a simple but powerful illustration. Imagine you have a $20,000 gain or maybe a large dividend distribution. The example compares what happens depending on where that $20,000 was generated.
Okay.
Scenario 1. That $20,000 was earned inside a traditional IRA and you withdraw it in retirement. Gets taxed as ordinary income. If your ordinary income tax rate in retirement is, say, 35%, that $20,000 withdrawal results in a $7,000 tax bill. Right. $20,000, 35%.
Yeah.
You only get to keep $13,000.
Now, $7,000 gone to taxes.
Precisely. Now, scenario 2. Imagine that same $20,000 was a long-term capital gain or a qualified dividend realized inside your taxable brokerage account. If your long-term capital gains tax rate is 15%, which is common for many, that $20,000 gain results in only a $3,000 tax bill, 20,000, 15%. In this case, you get to keep $17,000 after tax.
Whoa, so you keep $17,000 versus keeping $13,000 just because of where that $20,000 gain happened and how it was taxed. That's a $4,000 difference on just one $20,000 event.
Exactly. And when you scale that up across a whole portfolio with multiple gains and income streams compounding over decades, you can really start to see how you get to potentially significant figures like that $74,000 Vanguard simulation example. The tax drag is real, and reducing it matters.
It's a vivid illustration for sure. It's not just theory. It's about structuring things to keep more of your own money.
Absolutely. It's strategic tax minimization through portfolio structure.
Okay, so the theory makes sense. The potential benefits seem compelling. The strategies are getting clearer. But let's talk about the real world now. Is it always this straightforward, like just follow these rules and you're set? What complexities pop up?
Yeah, you've hit on a really crucial point. Our sources and just practical experience absolutely show that the right or optimal location strategy isn't always black and white. It often falls into the category of it all depends.
It depends. On what?
Well, lots of things. Your specific circumstances matter hugely. For instance, your current tax bracket is definitely a factor. But maybe even more critically, what's your expected tax bracket in retirement when you actually plan to start withdrawing the money?
Future tax rates. Predicting the future is hard.
It is. But if you have a reasonable expectation, say, you think you'll be in a significantly lower tax bracket in retirement than you are now, then deferring taxes in a retirement. Traditional 401k or IRA becomes highly attractive. You pay taxes later at that lower rate.
Makes sense.
But if you expect to be in the same or maybe even a higher tax bracket in retirement, perhaps due to required minimum distributions, other income sources, or changes in tax law, then the guaranteed tax-free nature of Roth withdrawals becomes much more appealing, even if you pay taxes up front now.
So your projection of future taxes is key. What else?
The specific types and amounts of accounts you actually have access to. Not everyone has a 401k with a Roth option, or maybe their income is too high to contribute directly to a Roth IRA. The contribution limits themselves constrain how much you can actually put into these tax-sheltered accounts each year. And of course, your overall net worth and the total size of your portfolio influence the scale and importance of these decisions.
And you also mentioned your investment time horizon and how you plan to take the money out eventually.
Absolutely critical. The strategy can and often should change significantly when you transition from the accumulation phase, working and saving for retirement, to the decumulation or withdrawal phase, where you're actually living off your investments.
How does starting withdrawals complicate asset location?
Well, in retirement, your asset location strategy needs to be tightly integrated with your withdrawal strategy. Think about the order in which you plan to draw money from your different accounts.
Like taxable first, then traditional, then Roth last. Is that common?
That's a common strategy, yes, often aimed at letting the tax-advantaged accounts grow longer. But whatever your sequence, it significantly impacts your taxable income each year in retirement, and ultimately, how long your money lasts. This withdrawal plan has to be considered alongside where your assets are located. For example, you might want to ensure you have enough living expenses covered in your taxable accounts for the early years of retirement so you don't have to tap tax-deferred accounts prematurely.
Okay.
Also, your asset allocation itself is likely going to change in retirement, probably shifting to be more conservative, with more bonds or income-producing assets. That directly impacts the types of assets you need to locate efficiently within your potentially new withdrawal framework. Retirement is definitely cited as a really critical time to review and likely adjust your AL strategy.
Makes sense. And we also touched on the fact that not all assets within a broad class are the same. Specific asset characteristics matter too, right?
Oh, absolutely. We already covered municipal bonds being a special case because they're already tax exempt. But think about other examples. Maybe you own a high-yield bond fund, technically bonds, but it might throw off a lot of interest taxed at ordinary rates. That might be better suited for a tax-deferred or Roth account, even more so than a regular government bond fund.
Okay.
Or consider a fund focused on certain alternative investments that might generate a lot of income, classified as ordinary income or short-term gains.
Yeah.
Again, probably better sheltered. And as we discussed, the difference between a low-turnover passive index fund and a high-turnover actively managed fund can make a huge difference in their suitability for a taxable account. You have to look beyond just stock or bond.
Got it. Nuance matters. And how does the need to rebalance your portfolio interact with all this? Keeping your target 60-40 or whatever mix on track requires periodically selling winners and buying losers.
Rebalancing. This is a key practical complexity. If your overall portfolio is spread across multiple account types, taxable, traditional, Roth, and you inevitably end up holding a mix of asset types, say both stocks and bonds, within your taxable account, which often happens, maybe it's your overflow account.
Yeah.
Then rebalancing within that taxable account can trigger taxes. Let's say stocks have had a great run, and now they represent 70% of your taxable account, but your target for that account, or overall, is lower. To get back in line, you have to sell some of those appreciated stocks.
Which generates taxable capital gains.
Exactly. It creates a tax spike right then and there.
Yeah.
This shows how the perfectly logical need to rebalance your overall asset allocation can sometimes clash with the desire for perfect asset location purity, especially if your taxable account holds a mix of assets that need trimming. It often makes sense tax-wise to do as much rebalancing as possible within your tax-sheltered accounts first, because trades inside an IRA or 401k don't trigger immediate taxes.
So there's the ideal theory of asset location, and then there's the messy reality of integrating it with ongoing portfolio management like rebalancing. It adds friction.
It definitely adds friction. And then, maybe the biggest complexity of all, investor behavior. The human element again. Sources consistently point out there's often a significant gap between these theoretically optimal AL strategies and how real people actually position their assets in the real world.
Why is that? If the benefits are potentially so large, why don't people just do it?
Or several reasons get cited. Complexity is a huge one. Let's be honest, understanding all these nuances of tax law, different account types, specific asset tax characteristics, it's not simple. It takes effort. It's just way easier to buy, say, the same target date fund in your 401k, your IRA, and your taxable account, even if that's demonstrably not the most tax-optimal approach. Simplicity wins sometimes.
Inertia, the path of least resistance.
Exactly. Another factor can be liquidity needs or maybe job insecurity. Someone might be hesitant to lock up too much money in tax-deferred accounts like a 401k or a traditional IRA, where withdrawals before age 59 and a half usually incur penalties, even if AL principles suggest putting bonds there. They might want more assets in their taxable account, even if less tax efficient, just so they can access the funds easily for emergencies or life changes without penalty.
So the very real need for potential liquidity can override the theoretical tax benefit. That makes sense.
Precisely. Also, the structure of employer-sponsored plans plays a big role. People often contribute to their 401ks, primarily to get that valuable employer match, which is absolutely a smart thing to do.
Free money.
Right. But this can sometimes lead to placing assets in that tax-deferred 401k, maybe company stock, or certain funds that might theoretically be better suited for a taxable account, simply because the 401k is where the match happens and where contributions are easiest. Inertia and just a basic preference for keeping things simple also play massive roles. People replicate strategies across accounts because it's easier to track.
It really seems like there's this constant tension, doesn't it? Between striving for perfect tax efficiency through complex AL and just keeping your overall investing strategy manageable and simple enough that you actually stick with it long term.
That's a fantastic point, and it's a key takeaway that some sources subtly highlight. While these complex models exist, often used by advisors, to precisely maximize after-tax returns, even among financial experts, there isn't universal agreement on the single best approach. Some researchers, like William Reichenstein, have done important work on optimizing AL using sophisticated after-tax metrics within quantitative frameworks. But for the average individual investor, maybe implementing some core, simple, sound AL principles consistently, like the basic bonds in traditional, stocks and taxable Roth idea, might provide the vast majority of the potential benefit without getting bogged down in overwhelming complexity. Some argue that unless your tax situation changes drastically between your contribution years and your withdrawal years, the actual real-world difference between perfect AL and a slightly simpler, slightly less optimal but consistent approach might not be quite as dramatic over decades as some simulations suggest, especially if withdrawal tax rates end up being similar to contribution rates.
So good enough might be better than striving for a perfect complexity you can't maintain.
It's a very pragmatic perspective. Consistency beats complexity sometimes.
Okay, so connecting all of this back to you, the listener, why should you care so deeply about understanding this difference between asset allocation and asset location? What's the real power in knowing this stuff?
Because, look, despite all the complexities we just discussed, despite the behavioral hurdles, consciously thinking about and implementing even basic asset location principles can have a truly material impact on your long-term financial well-being. It's not just academic theory, it's practical dollars and cents. By strategically minimizing the taxes you pay year after year on your investment returns, you allow more of your money to stay invested and compound. And that directly translates into a larger portfolio balance over your lifetime. More wealth.
It really is just smart tax planning, isn't it? It's about using the rules of the U.S. tax system as they currently exist to ensure you're not paying a penny more in taxes than you absolutely legally have to. And that directly boosts your after-tax return, which, let's face it, is the only return that actually matters for achieving your financial goals.
Absolutely. It adds this layer of sophistication, this extra dimension to your overall wealth management strategy that is arguably just as important, maybe even more directly impactful on your final net return as trying to pick the single best stock or perfectly time the market, which we know is incredibly difficult, if not impossible, consistently. Asset location is a controllable variable in the often uncontrollable world of investing.
So to quickly recap this whole deep dive then, asset allocation, AOA, that's your big picture strategic decision about the mix of asset types in your portfolio, your blueprint for balancing risk and expected return.
Right, the what. And asset location, AL, is the more tactical implementation decision about where within your various account types, taxable, traditional, Roth, you actually hold those specific assets. The goal, to minimize the tax drag and maximize your after-tax returns. The where.
They are distinct concepts, AA and AL, but they are both absolutely fundamental pillars for effective long-term wealth building, especially for U.S. investors navigating our tax system. The crucial takeaway seems to be, pay attention to where you place each type of asset, making that decision based on how that asset's income and gains are typically taxed and how the specific account types you have access to are taxed.
Well put. Now, considering all the nuances we've explored, how the optimal strategy might shift in retirement, the complexities that rebalancing introduces, the challenges of dealing with specific unique asset types, and maybe most importantly, those very real, very human tendencies towards simplicity or prioritizing liquidity over achieving mathematically perfect tax optimization.
Yeah, thinking about all that, it does raise a final kind of provocative thought for the listener to mull over, doesn't it?
I think it does. Given the clear, demonstrated potential benefits of asset location, but also acknowledging the admitted complexities and those real-world behavioral challenges in perfectly implementing and crucially sticking with an optimal strategy for decades. Maybe the ultimate challenge for most investors isn't just knowing the most theoretically intricate, perfectly optimized AL strategy.
What is it then?
Instead, maybe the real challenge, the practical one, is finding a sustainable approach to asset location, one that strikes the right balance for you personally. Balancing achieving significant, meaningful tax efficiency with the very real need for simplicity, maybe some flexibility, and ultimately ensuring your strategy is one you can actually understand, believe in, and maintain consistently throughout your entire long investing journey. How much complexity is truly necessary to capture most of the benefit versus how much complexity becomes too much, potentially causing you to abandon the strategy altogether when life gets busy or markets get scary.
That's a fantastic point to end on. It's not just about the math, it's about making this powerful knowledge actually work in the messy reality of your own financial life, finding that sweet spot between optimal and doable.